Welcome to Saz Talks Money on Valuetainment. I'm your host, Adam Sosnick, and I'm here to help you, yes, you, build your wealth and save that money. On today's episode, we're going to be breaking down how you can win the interest rate game. Let's talk money.
All we talk is money. All we talk is money. All we talk is money. All we talk is money.
Now, we've all heard that money's a game and you got to get in the game to win the game. We're talking about capitalism and building wealth and winning the money game. And let me tell you something, to win the money game, the cornerstone of winning the money game is winning the interest rate game. Did you catch that right there? To win the money game, you need to win the interest rate game. So behind me, what we have is a little bit of information for you to get real deep into when we're talking about the interest rate game. Now, what you see right here, a couple key terms when it comes to interest. Right here, we have a little bit of winning the interest rate game and losing the interest rate game, and then we'll circle back at the end on what it all means to you and how you can win the money game. So with that being said, let's dive right in to the key terminology when it comes to interest. Now, what is interest? Interest is this. It's a fee paid to borrow money. No big deal there. It's a fee paid to borrow money. Cool, we got that. Now, what is the interest rate? The interest rate is the amount the borrower pays. This is sometimes called the APR, or the annual percentage rate. Then you have what is known as compound interest. Compound interest is a lovely, lovely, lovely thing, folks. Compound interest is your interest making interest, and your money making money on your interest on your money, and your money making interest. It's a beautiful, beautiful thing. I sound like a rap video right now, but that's money on money on money on money, and that is a very magical effect. In fact, I have a quote for you. Here's the quote. Compound interest is the eighth wonder of the world. He who understands it earns it. He who does not pays it. You know who said that? Only the smartest person to live in the last 100 years, Mr. Albert Einstein. Now, if you don't know Einstein, folks, you need to do a little bit more reading on your end. So that's Einstein. So let's talk about earning interest versus paying interest. Earning interest versus paying interest. Now, when you talk about earning interest, that is when you're being paid on your money. That is known as investing. That is winning the interest rate game. That is also known as appreciation. A lot of good things over here. Everything in green is what is known as your best friend. Now, speaking of best friend, what's your worst enemy? Well, your worst enemy is you paying interest. That, my friends, is known as debt. Debt is your money going backwards. As you can see, this is depreciation. This is losing the interest rate game. So let's go back to Einstein. He who understands compound interest earns it. He who does not pays it. Okay, we got that. Now, as you can see behind me, there's a graph, and we break down what it means to win the interest rate game and what it means to lose the interest rate game. Should we start with losing or winning? Where should we start? We'll start with losing because we'll finish strong at winning. That's my take on this. All right, cool. So what does it mean to lose the interest rate game? That is in red, and then in green is obviously winning the interest rate game. At the top of the chart, you have inflation. Inflation is a silent thief in the night that steals your purchasing power without you even knowing it. That's what inflation is. Now, inflation on average over the last 100 years ranges between 2 and 3%. I'll give you a quick case example on inflation. 50 years ago, you wanted to buy a Coke. It might have costed you a nickel. Back in the 1980s, 1990s, you wanted to buy a Coke. That was 50 cents. Now it's 2020. A Coke is $1. It's still the same Coke. It just cost a different price. That is a quick lesson on inflation. So inflation ranges between 2 and 3%, as we discussed. Now, as we go down the line here, this is from least to most amount of losing. So let me say that again. As we go down the line here, this is more and more losing the interest rate game. So next up are mortgages. Mortgages right now are freaking all-time lows. Currently, you're at mortgage rates at 2.5% to 4%. If you go back in time, 1980s, 1990s, interest rates were like 10, 12, 15%. That's crazy. Now interest rates range between 2.5% and 4%. Now might be a great time to look into getting a mortgage if you're interested in buying real estate. Cool. Moving on, we got student loans. Student loans, you want to go to college, you want to take out 50, 100 G's to go to school, to learn. Cool, I get it. But you're going to have to pay between 3 and 6% interest on your money. Cool, that's how student loans work. Now you got car loans. There's a difference between car loans on new cars versus used cars. So what I have here are ranges, right? So there might be, I actually pay 4%, but you said that it's 5%. These are ranges, folks. So just to understand how these numbers work, on a new car, you're looking at somewhere around 5%. On a used car, you're looking at somewhere around 11%. Again, a car is a depreciating asset. Some may call it a liability, but either way, you're looking at between 5 and 11% depending on the type of car. Moving right along, you got business loans. You got a business, you need to take out a loan. This can vary. That's why I got asterisks over here. You got different type of loans. Things may vary. We understand that. Business loans can range between 2 to 7 to as much as 13% on a loan for your business. Moving right along, we got personal loans. Now, personal loan can range between 6 and 19%. That's quite the variance right there. Now, what is a personal loan? Personal loan is basically a consolidation of a couple different loans that you might have. You might have a credit card that you're paying 10% interest on. You might have a credit card you're paying 20% interest on. You consolidate it into one personal loan, one account, and you're paying one number. That's basically a personal loan where you're paying between 6 and 19%. Cool, we got that. Now let's move on to credit cards. We all got credit cards. You go to college, your first day of college, there's people out there giving credit cards. Sign up, they give you a free t-shirt. Cool. You're signing up for a credit card. Next thing you know, you're paying between 14 and 18% interest on a credit card. Stop the presses, folks. You gotta understand that if you're paying the minimum payment on your credit card, you might be paying that minimum payment forever, like Outkast said back in the day. The last thing you wanna be doing is paying interest on a credit card. Minimum. You're racking up between 14 and 18%. In my opinion, anything over 5-6% interest, now you're ending up in murky waters, certainly in double digits. It gets a little scarier, right? Speaking of scary, let's talk about some of the worst types of debt that you can be paying. And this ends with cash advances and payday loans. Cash advances and payday loans. Cash advances is when you want to take cash from your credit card. You might be paying as much as 20 to 250%. Let me say that again, as much as 250% for a cash advance. And then a payday loan is when you got payday on Friday, but you need money on a Monday, so you go out for a payday loan. We've all seen these places on the side of the road come in for quick cash, payday loan. These are astronomical interest rates that can be as much as 400 and 500%. This is stealing money from yourself. This is the epitome of losing the interest rate game. If you can, please avoid cash advances and payday loans. They are not a good look, and they will only kill your wealth. With that said, let's talk about winning the interest rate game now. Let's talk about winning the game. Now, winning the game, it starts with stacking cash and saving that money. You know that is my favorite phrase. But here's the deal with saving that money. You don't make interest on your money. The whole point of saving money and stacking cash is not to make interest, and I'll give you an example. If you're saving money and you got money in the bank, it's in a checking account or even a savings account, maybe you're making between 0.1 and at the very most 1.5 to 2%. Let me say that again. Stacking cash is not about interest. Don't really focus on the interest rate. Just focus on stacking cash, because maybe you'll make between 0.1 and 1.5 to 2% on your money. That's cash, but that's the beginnings of winning the interest rate game. Then from there, you have what are known as CDs, or certificate of deposits. That's what you put your money in a bank for 6 to 12 months. You can't touch it. And you maybe make 0.5% on your money. Not exactly winning the interest rate game, but it's better than losing. So with that being said, let's talk about what it starts to mean to win the interest rate game. Then you have your home appreciation. Half of the people in America right now are homeowners. You understand about home appreciation. On average, if you have a mortgage and you have a house, your home will appreciate over time between 3 and 5%. Cool, you got it? Your money is making money on appreciation, 3 to 5% over time. Cool, then we got bonds. Now we're talking about investments. Now we're talking about government bonds in this case. On average, this is returning or yielding, right? You know that word. Bonds yield between 5 and 6% over time. Now a bond, just in case you don't know, is an IOU to a company, or a government in this case, is where you lend money to the government or a company and they pay you back over time. When the bond matures, you can make between 5 and 6% on average. These are average numbers here. Then you have the Dow Jones. Now, and we're talking about stock market investing now. We were just talking about bonds. Now we're in the stock market. The Dow Jones are the top 30 US stocks in America. These are top blue chip stocks, top blue chip stocks. They yield on average 7.5% if you're investing in the Dow Jones index. A lot of times when you hear the market did this today or the market did that today, they're often talking about the Dow Jones. But when you really want to invest in the stock market, it's not necessarily the Dow Jones that you need to be focusing on, it's the S&P 500. We all understand that the S&P 500 has 500 of the largest companies in America within the S&P 500. That's kind of how that works. Over time, the S&P 500 will yield 9.8% return on your investment. Not bad. I'm a big advocate of index investing in the S&P 500. Go check that out if you're not familiar with that. Cool, then we got REITs. I'm not a big real estate investor, but I am a big REIT investor. What do I mean by that? Meaning I rent. I've done episodes on renting before, or why I rent and I don't buy. I don't like to be tied down. I like my money moving. I like to be able to go with the flow and have flexibility. But I do invest in real estate investment trusts, REITs. This is investing in real estate, commercial property, residential properties without having to have a mortgage and be a homeowner. So check out REITs. On average, REITs will return between 10 and 12%. If you're renting and you want to invest in the stock market, I highly advise you look into something called REITs. Cool, check it out. Then you got ETFs. These are known as exchange traded funds. This is where you can buy and sell mutual funds as if they were certain stocks. I'm a big buy and hold investor, but if you're going to look into ETFs, these on average will return somewhere around 12%. Not bad at all. Then we're moving on. We got hot stocks and crypto. Now you can see that there's an asterisk right here. There's a plus or minus 20%. That's just kind of how it falls on the chart. Meaning you might have a hot stock or a crypto portfolio of some capacity that might make 20, 30, 40, 50, 100% of the investment, crazy investments, but you could also lose that amount of money. So understand that something like that, just investing in individual stocks or something as far as crypto goes, has high risk and high reward. That's up here if you can win that game, but it could be potentially losing. So just proceed with caution when it comes to buying individual stocks or crypto. But I felt the need to put that on the chart. Moving right along, then you got businesses. People who invest in businesses are looking for somewhere between 15 and 30% yield. And business, for all my entrepreneur friends out there, I understand where you're at. You don't want to necessarily have a 2, 5, 6, 10% return. You're looking for a higher return on your sweat equity and putting in the time and being an entrepreneur, investing in business. Cool, I get it. The reward for that is somewhere between 15 and 30%. And if you completely kill it, it could be more than that. Last but not least, do you know what is the highest on this list? The highest on this list, 100% investment. Well, it's investing in yourself. Warren Buffett once said, the best investment you can possibly make is investing in yourself. What does that mean? That means in getting smarter, getting stronger, getting sexier, getting cooler, getting more knowledgeable, just getting everything that you want to be, being the best version of yourself. There is no better investment than investing in yourself. Cool, you got it? Now that, my friends, is winning and losing the interest rate game. So just to wrap that part up, the best investment you can possibly make is investing in yourself. The worst investment you can possibly make is borrowing money from yourself to pay yourself. It's a never-ending game. It's like a cat and mouse game that you can't win. So invest in yourself and definitely don't do payday loans. So that's the best and worst of investing. Now let's get back to where we started at the beginning of this episode, which was winning the money game. I said that the interest rate game, or winning the interest rate game, is the cornerstone of winning the money game. Now, if you have not seen my episode on winning the money game, we'll definitely put a link of that at the end of this episode, but let me recap what it means to win the money game. Now, understanding the winning the money game, there's 6 principles of wealth. There's not 100 different things. You got to read 50 different books. You got to take 100 different classes. Be great at these 6 things. I'll give you a quick recap. Number 1, it starts with a game plan. A budget is a game plan for your money. Understanding a budget, understanding your income, understanding your expenses, understanding having a net worth mentality, not a paycheck mentality. That is having a game plan for your money. That is numero uno, number 1. Then you have number 2, the second principle of wealth, which is getting out of debt. We just recapped what it means to be in debt. This is spending money. This is money going backwards. This is having a spender mentality in a lot of cases. It's very important that if you're going to win the money game, you got to get out of debt, have a payoff plan for your debt. And then when you can pay off that, now you can start getting into the saving that money component, and then obviously the investing. So principle number 3, which I had right here, zing, right there, save that money. Saving is the key to wealth. I encourage you, as you heard me say here before, save 10 $10,000. If you have not done that, I promise you, saving $10,000 is an awesome feeling. Most Americans have not done that. You might be saying, well, what do you mean most Americans not have done that? I'm telling you, most Americans have not saved $10,000 in their life. So if you can do that and save that money, save $10,000, then my friends, it is time to become an investor. And we talked about the benefits of investing and how much interest, compound interest, you can make when you become an investor. There's two key ingredients when it comes to investing: time and compound interest. Time in the market and your compound interest, as we discussed before, that's interest making interest and your money making money. Become an investor. Then after that, you want to protect everything you have. You want to ensure your biggest asset. What is your biggest asset? Well, we discussed this earlier. It is you. You are your biggest asset. You are your best investment. Protect yourself. That's health insurance, that's life insurance, that's disability insurance. God forbid something happens to you, make sure you're protected. So once you've done all those 5 things, then you can end up where you're chilling. And chilling is when you own your time, you're out of debt, you've saved that money, you got investments going on, you're making compound interest. Compound interest, we understand it's the 8th wonder of the world. It can be your best friend. You become an investor. Now you chilling. And that's it. That's how you win the money game. And the cornerstone of winning the money game is understanding the interest rate game. And just like Albert Einstein said, he who understands it earns it, and he who does not pays it. So now hopefully you have a better understanding of what it means to win the interest rate game with the good help of our friend Compound Interest, the 8th wonder of the world. And that's it. That's the end of this episode. Hopefully you enjoyed this episode. Hopefully you learned something. If you did, please leave a comment below, just so you know I read all the comments. I respond to the comments. I appreciate you taking the time out of your day to learn something from these videos and dropping a comment and giving me your feedback. With that being said, if you have not seen this episode on how to win the money game, the 6 principles of wealth, we're going to put that for you right here. And if you have not seen this episode on how to invest then versus now, check that out. That will help you become a better investor today. With that being said, if you have not subscribed to Valuetainment Economics, please subscribe below and smash that like button while you're at it. And as always, save that money.
All we talk is money. All we talk is money.